But the idea that I didn't understand that some of the selling in Exxon was non-repeatable is inexcusable. I thought, and many speculators are guilty of the same stupidity, it could go lower. I looked at the direction of the market, and I looked at the narrative. I looked at the community's fear, and I didn't pay attention to the juxtaposition between price and value. And I also didn't look at the obvious, that reflexive selling. And let's say nothing changes with regards to Exxon, with regards to the company. They're maintaining sustaining capital, their profit ratios are okay, they're maintaining production, all that stuff. The world doesn't like oil. I was just at Metals, well, not just, 3 months ago or so, I was at Metals Week in London. And that's a big group of conferences. Some are industry conferences, some are investment conferences, but it's worth doing. And we heard from a global markets consulting firm, people need to read down below the headlines. I qualified that. I sold 80% of my physical silver.
Okay.
Silver occupied a speculative position in my portfolio. I've sold no gold. I save in gold. I bought the silver, 5 years ago, and I bought it because silver was hated. And I theorized that when silver became unhated, that it would trade from 20 to 50. Silver became unhated, and it traded from 20 to 50. In fact, it traded through 50.
Traded 120.
Correct. For me, when the reason to own an asset class goes away, I either have to give myself a very good new reason, or I have to sell the asset class. In the speculative part of my portfolio, my expectations for silver were met. And I had to consider, is physical silver the best place for my speculative dollars in my speculative portfolio? And I concluded no. Specifically, by the way, I sold my silver in the mid-70s.
Okay.
Specifically, I decided that the silver price didn't have to go up. It could go up. I think it will go up, but it doesn't have to go up. When I bought it, I thought it had to go up. And then I thought, let's say, just for fun, that the upward pressure is off silver for a year. That the move from 20 to 100 or 20 to 75, or however you measure the move, released the tension in the coiled spring that had existed since silver was selling for $20. So let's say that silver traded sideways for a year. By definition, if the asset traded sideways, I wouldn't make any money on it. But interestingly, if the asset traded sideways for a year, the best silver companies are traded predicated on a $45 price assumption. Their earnings forecasts and their net present value assumptions use a $45 metric. If the silver price stays at $75 for a year, it's arguable that the best silver companies go up 50%. So as a speculator, I'm chosen between an asset that arithmetically at least goes sideways and one that could go up 50%. It becomes more interesting in the event of a silver price decline. If silver prices were to fall from 75 to 50, that would obviously have a material impact on the value of my silver holdings. But arguably, although market sentiment might change, if the silver price was to fall from 75 to 50, and the net present value calculations were done at a $45 price, I could arguably be better off in the silver stocks than in the silver.
Right.
Better upside with a sideways move, equal upside to an upside move, better protection to a downside move, better speculation. It's all arithmetic for me. Now, I understand that people will say, but there's a monster short squeeze, or whatever they say. The silver isn't going to merely go through the roof, it's going to go to the moon. That's all narrative. I do arithmetic. Silver gave me what I wanted. There was a higher quality speculation available to me. I took it.
Would you do the same thing as gold?
No. Silver occupies a speculative position in my portfolio. For me, gold is a savings asset. I have saved principally in gold. I maintain a lot of liquidity in US dollars, but I save primarily in gold. I think will come a time in my life when there is an investment, not a speculation, but an investment that's so compelling that I will reduce my liquidity, I will reduce my savings, which is to say I will sell some gold and transfer in that asset class. I did it in 2010. Nowhere near enough in retrospect, but I did it in 2010. And given that I save in gold and I maintain liquidity in gold, it's easily conceivable that there will be a set of circumstances where my greed overwhelms my fear, and I'll sell some gold and I'll buy that investment. But until then, my gold isn't for sale. It could be, depending on how equity markets and other markets price themselves for the rest of my life, that the sell decision on my gold is made by my heirs and successors.
What did you buy in 2010?
A variety of things, but what really fell off the table in 2010 a few things. One, I was underinvested in the broad economy. And Berkshire Hathaway fell by half. The value of the businesses didn't fall by half, the price did. The Chubb Insurance Group, who I compete with every day, fell by 60%. W.R. Berkley fell by 55%. The oil companies got slaughtered, and the pipeline companies fell to the extent that the best of them, Kinder Morgan, was yielding 13%. By the way, a tax advantage 13%. That was just too appealing to me. It was just too appealing. Now, the prevailing zeitgeist was that the market was going to go to zero, which is, of course, why those bargains were apparent.
Yeah. Did you buy anything during COVID?
I did. I waited 45 days too long to buy Exxon, I'm embarrassed to say. That was one of the biggest errors of omission in my life. The oil price fell from 85, 90 bucks briefly to zero, stabilized at 20. I knew at the time that in order for the oil industry to pay their taxes and earn their cost of capital, that oil had to sell for 60. So you make the stuff for 60, you sell it for 20, you lose 40 bucks a barrel, you do it 80 million times a day. It gets kind of tiring,
Right.
The oil price had to go up, George, or your car wouldn't start. What do you think the probabilities of either of those two events occurring are? So, with Exxon, I compounded the sin because they fell as a consequence of then getting kicked out of the Dow Jones Industrial Index. And so all the index funds had to sell them. Now you can only get kicked out once, right? You can't get kicked out 5 times. And the idea that I didn't understand that the oil price had to go to 60, well, I did. But the idea that I didn't understand that some of the selling in Exxon was non-repeatable is inexcusable. I thought, and many speculators are guilty of the same stupidity, it could go lower. I looked at the direction of the market, and I looked at the narrative. I looked at the community's fear, and I didn't pay attention to the juxtaposition between price and value. And I also didn't look at the obvious. That reflexive selling had to be a one-off because they couldn't get kicked out again. Stupid.
While silver was treated as a speculative trade, gold remains Rick Rule's primary savings vehicle. He views gold as protection against monetary instability, inflation, and systemic financial risks. Central banks worldwide support this perspective. In recent years, institutions like China, India, and Russia have significantly increased gold reserves to reduce reliance on foreign currencies. Unlike stocks or bonds, gold carries no counterparty risk. Rule only sells gold when extraordinary investment opportunities appear, such as during major market crashes. Until then, gold functions as financial insurance. Its purpose is stability, preserving wealth during economic uncertainty rather than generating short-term speculative gains.
Assuming that the price doesn't move. Money is made on the delta between price and value. Nobody is ever going to get the value calculation right. But if they try, they can get it more right than other people because most people don't try. So, as an example, let's say I own Exxon at 100. And let's say nothing changes with regards to Exxon, with regards to the company. They're maintaining sustaining capital. Their profit ratios are okay. They're maintaining production, all that stuff. The world doesn't like oil. Maybe Greta Thunberg gets made prime minister of somewhere or something like that. And the price of Exxon falls from 100 to 70. I'll likely buy a lot more. A lot more. Or if Exxon, as they did in COVID, makes a discovery in a frontier basin offshore Guyana, and it starts looking to me like it's going to be 10 billion barrels. I was wrong, by the way. It was 20. And the price doesn't move. In the face of a discovery that's so big it can move the dial on Exxon, I'll buy more. If the facts change, my estimation of value changes. And if my estimation of value is substantially in excess of the price, that changes. Every time I buy anything, George, I write myself a memo as to why. And once every 90 days, I reread all those memos just to refresh my memory and keep me from getting lazy. Particularly people who buy junior mining stocks end up with these idiotic laundry lists of 60 or 70 little positions that after a while they forget they have or can't spell or pronounce. And I was guilty of that. And so I review every 90 days what I own, why I own it, and what news has transpired in the last 9 months, and whether or not that's been reflected in price levels. And I make sell decisions.
History shows that the best investments emerged during financial panic. Rule recalled purchasing major companies during the 2008 crisis and energy stocks during the pandemic collapse. Oil prices briefly fell below production cost, creating unsustainable conditions. When commodities trade below economic reality, supply eventually contracts and prices recover. These situations reward investors who focus on fundamentals instead of fear. Timing exact bottoms is impossible, but identifying undervalued assets remains achievable. Patient investors who understand supply, demand, and production economics can capture enormous gains. Market crashes often represent not destruction, but temporary mispricing driven by emotion and short-term uncertainty instead.
I was just at Metals, well, not just. 3 months ago or so, I was at Metals Week in London. And that's a big group of conferences. Some are industry conferences, some are investment conferences, but it's worth doing. And we heard from a global markets consulting firm the result of a consensus survey that they ran through the biggest mining companies in the world. And those companies collectively said that they had to invest a minimum of $250 billion in new project expenditures in the next 10 years to maintain copper production where it is today. Now, that's an interesting statement, to maintain copper production, because copper's in a deficit. We're using more than we're producing. So in order for the deficit not to grow, they need to invest $250 billion, which, by the way, is $100 billion more than they have. On top of that, copper demand is growing at 2.2% compounded. So if they tread water for 10 years, spending $250 billion, there's 2.2% demand escalations compounded over 10 years on top of an existing supply deficit. There is no way, no physical way in the world that supply and demand are going to meet 10 years from now, without dramatically higher prices.
Is that not priced in, Rick?
I mean, copper's had a nice move, but it hasn't had as nice a move as you would expect in 2025 if you paid attention to fundamentals. Okay. But in 2025, we were already in a deficit between new mine production, recycling, and consumption. And in 2025, 7% of world supply came out of production. Grasberg, Kamoa Kakula, Cobre Panama. One would have expected a market that was in deficit in the face of a 7% reduction in supply to fly. It moved rather nicely, but it didn't move the way it would move if the impending shortages were priced in the market. But it gets, depending on your point of view, better or worse. The cost of putting new projects into production, according to the copper industry, is increasing by about 8 to 10% compounded annually, which means what is today an $8 billion porphyry construction project becomes an $8.6 or $8.7 billion project next year, and a 9.5 or 9.6 job the year after that, and a 10.5 job the year after that. And so the $250 billion that we're talking about are $225.
Right.
In other words, the problem gets worse. At the same time, the higher copper prices that we're seeing around the world are attracting immediate responses from government. Higher taxes, higher off-concession expenses by copper mining companies, building schools, drilling water wells, bribes, whatever. Higher taxes. So the company's cost of capital are going up because their retained earnings are being reduced by government theft. At the same time that the capital costs of building projects are going up, at the same time that they have to make major investments to maintain current supply deficits using money they don't have. All of this came together 4 days ago in the announcement by the largest mining company in the world by revenues, BHP, that they raised $4.2 billion by selling a byproduct silver stream on their copper production. That tells you that the biggest mining companies in the world know that they are capital constrained in a market where at least the nominal price of the product has to rise. Can't not rise. The only thing that would damage or destroy that thesis would be a worldwide depression. In other words, the supply decreases are inevitable. The only way you maintain pricing levels is you decrease demand. And the only way that happens is if people are unable to pay.
Yeah, but that's temporary, right? That's a quarter or two, maybe a year, even looking at the
GFC for 3 years. That seems like an eternity to most people. I've been investing now for almost 60 years. It's ironic, George, that as I have less time on Earth, I become much more patient. Not because I don't have time preference, but rather because I've learned in my lifetime that my time preferences don't matter.
Yeah.
I invest in themes that take 5 years or 6 years or 7 years to play out. Mercifully for me, many of my competitors whose strategies might be better have trauma holding stock over a long weekend. And I end up doing better than they do.
Copper is emerging as one of the most critical commodities for the future. Global electrification, renewable energy, and artificial intelligence infrastructure require massive copper supplies. However, mining companies face growing challenges. Industry estimates suggest over $250 billion must be invested just to maintain current production levels. Meanwhile, demand continues rising steadily. Major mining companies are already selling future production rights to raise capital, signaling financial strain. Without sufficient investment, supply shortages appear inevitable. This imbalance between rising demand and constrained production creates conditions for significantly higher prices. Copper's importance may rival oil's historical role in shaping economic power.
Yeah, and it makes perfect sense. If you take the cash flow from silver and you isolate it in a royalty or stream, make it a financial instrument that doesn't have operating costs or sustaining costs, that cash flow sells for between 15 and 17 times cash flow. It down to a 4 or 5% yield. That same cash flow in a copper wrapper, it's priced at 5 or 7 times cash flow. So the cash flow is almost 3 times as valuable in a silver stream as it is in a copper company. So BHP can sell that silver credit to Silver Wheaton. Both sides win on the equation. In other words, it's accretive to both companies. And it's both companies in $4 billion chunks. One sidebar takeaway from this discussion, George, we're talking about copper, but the knock on Bay Street and Wall Street against the royalty and streaming companies is that the huge transactions that made them what they are in the past. That's exactly wrong. The huge transactions are in the future. The royalty and streaming companies are the solution for part of the capital stack around the $250 billion that the mining industry has to invest in the copper business.
Yeah. When you just talk about revenue streams and promised revenue streams, it makes me think of private credit. And have you been following what's going on with Blue Owl and the whole
Sure.
cockroaches?
I've been in the private credit business for 45 years.
What's your take on that, Ben? I'm curious.
I mean, it was a really good business 35 years ago when those of us who knew one industry provided private credit in that industry.
Right.
In other words, I was a fairly prominent provider of credit to junior exploration companies, to newsletter publishers, and to oil and gas mineral rights owners. I knew those industries really, really, really well. I knew them well enough that I could borrow money at prime, 50% loan to value, from big banks who knew those industries less well. And I could lend that money out at prime +4 or prime +5 and exist on the spread. The spreads that guys like me were getting were, I mean, make no mistake, they were pretty attractive spreads. When we made a mistake, it came and clipped us. But in those days, 40 years ago, you didn't make many mistakes because you stuck to an industry you knew well. Then the BlackRocks of the world came in, the masters of the universe, and those guys are really smart. They're twice as smart as me, which is not smart enough to take the risks that they take. In other words, they thought because they got paid back in apartment construction, that they would get paid back in board game manufacturing or plywood.
Yeah.
They tried to become spread lenders in industries they didn't know. When I was in school, George, I was taught there was 3 C's in lending: character, credit, and collateral. Now, if you're the smaller end of the market, private credit, all your borrowers are characters, so they get no credit for character, right? They're all characters. And none of them have any credit, or they wouldn't come to me, right? So it's all about collateral. If you don't know how to value the collateral, you don't belong in the business. And Blue Owl, I mean, those guys really smart, really smart. I only know 2 industries. I know natural resources and I know conventional financial services. And I'm an old man. These guys thought they knew 100 or 150 industries. That's an impossibility. And if my balance sheet, Rick Rule's balance sheet, I mean, the way it used to work with me and my senior lender was I would get 50% loan to value, and no loan in my portfolio could be more than 10% of the total portfolio.
Mm-hmm.
The private credit guys characteristically are running 80 or 85% debt, meaning that they have a 10 or 15% equity slice. Right. And these guys have no loan more than 20% of total capital, which is to say one loan can be 130% of their total equity. Mm-hmm. If they make a mistake, they're extinguished. So I limited risk by an old-fashioned paradigm. I understood what I was doing. Unique, right? And I also limited risk by limiting risk. I employed 50% leverage as opposed to 85 or 90% leverage. And I never let one loan be more than 10% of net asset value or 20% of my equity. If Blue Owl had done that, they wouldn't have done it because there wouldn't have been the management fees
right,
that they looked for.
And there was demand from the pension funds because the pension funds promised 7% and they're only getting 3 or 4% on a treasury.
Yep. There's nothing that sells as well on Wall Street as an untrue promise supported by popular narrative.
Despite recent volatility, long-term oil fundamentals remain strong. Global underinvestment in oil exploration and production is reducing future supply capacity. In the United States, shale production growth is slowing as the most productive drilling locations become exhausted. Without new technological breakthroughs or increased investment, production will plateau and eventually decline. Meanwhile, global energy demand continues rising. These structural trends suggest higher prices over time. Energy companies, particularly service providers and drillers, may benefit significantly from tightening supply conditions. Energy markets operate in cycles, and current underinvestment is laying the foundation for future price increases worldwide today.
That's really the cash bonuses, and we've driven on to destroy some other balance sheet.
Yeah, and if we're big enough, then the Fed bails us out. So you have a free call option.
Well, that's something different. That's not you and me. That's the people who employed us. The only guy who gets screwed, of course, is the taxpayer, as usual.
Or the investor, the retail investor. So what type of, you having an insider knowledge of that business, how concerning are the red flags when a blue owl tries to, like what they did 6 months ago or whatever, when they try to merge two funds and they say that it's for shareholder value, but you look at the net result and that keeps money locked in. And now what they're doing, of course, is they're just admitting that, okay, we're not going to give you your money back. How big of a red flag is that, you knowing the business?
Well, I wasn't a partner in any of the Blue Owl partnerships, but clearly, had I been, had I seen that they were having to do wholesale sales to fund distributions, it would have been clear to me that they were insolvent. I wouldn't have needed for them to do overt auctions, because you would have seen, had you paid attention, in the interplay between the balance sheet and the income statement, that these guys were toast. But the warning sign should be earlier on. The warning sign for the investor should be, these guys are in 60 businesses or 70 businesses.
Right.
Who specifically is the underwriter? And what specific expertise does that underwriter have? In terms of their capital, if they're funding it in the debt markets, is it overnight funding? Is it a revolving credit facility? Or is it a 5-year term?
Right.
What is their debt to equity ratio? What's their concentration? Anybody who would have applied those fairly simple tests would not have invested. The fact that these pension investors in the country did invest tells you an awful lot about the level of due diligence that takes place in university endowments and pension funds.
Yeah, non-existent, because the tide's in, Rick.
Correct.
The tide's in, and everyone thinks that the tide is going to be in forever. So why do due diligence when you've got that, let's say, 3% discrepancy between your liabilities and what you're making on the asset side of your balance sheet? You got to fill that gap somehow. And everyone's doing it, Rick. Everyone's doing it. So if you don't do it, then you're going to get fired as long as the tide's in, right? So, I mean, my next question is, assuming that, do you think Blue Owl's a one-off in the credit space?
Oh,
do you think that if they're doing it, then that means there's a lot of other people doing it, and there's probably going to be a bigger impact on other balance sheets than we've already seen?
I see a lot of sin in the mid-tier private credits.
Right.
My suspicion is that the really veteran managers who have who have less debt relative to equity on their balance sheets, I'm thinking Ares is an example, and have longer experience in private credit, will probably do well. Because when the mid-market guys, the Johnny-come-latelys, get squeezed out, Ares is going to buy what had been a 12% running yield at 70% discount to book.
Yeah.
With a 5-year term, that means that they're going to accrete the 30% over 5 years, and the running yield is going to go from 12 to 15. But people are going to have to choose their manager. They're going to have to do due diligence. I don't want people, because Rick Rule has said that Ares is going to do well, to go out and buy Ares. I want them to get on a quarterly conference call, ask the question, what is your debt to equity ratio? How are your funding plans? How much of it is in the 5-year or 7-year market, and how much of it is overnight funding? What are your concentration limits? If you're lending in the mobile home business, do you have anybody there who knows anything about mobile homes?
Novel idea.
Yeah. I do this. And, sometimes you hear management teams on a call say, I can't believe you're asking me this stuff. Well, it is my money, mate.
Yeah.
Beyond commodities, Rule warned about growing risks in private credit markets. Many lenders have expanded into unfamiliar industries, increasing leverage and weakening lending standards. Pension funds and institutions seeking higher returns often overlook these risks. When economic conditions deteriorate, excessive leverage can trigger rapid losses. Experienced investors avoid this by focusing only on industries they understand deeply. Successful investing requires discipline, risk management, and patience. Those who chase popular trends without proper analysis face the greatest danger. Financial stability depends not on following narratives, but on understanding value, managing exposure, and maintaining long-term strategic perspective always.